Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to be working through a consolidation problem, a consolidation where we have a parent-subsidiary relationship. We're going to be putting together the two trial balances together as if one entity. We will have both downstream and upstream transactions that we will be dealing with. Some of the major things we will be dealing with. We'll also be using a modified equity method in this consolidation process. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We got the information on the left-hand side. We're going to be entering that into the blue area on the right-hand side where we have various worksheets, and then we're going to have our consolidation worksheet to the right. Let's check out our information. We have P purchased a percentage of S voting common stock, that percentage being 80%. Happened in 2000 X0. We will be, in essence, doing the consolidation as of 2000 X3. So we're talking, X0, 1, 2, 3, 4 years we're talking about, including X0 in that. Then we have the percentage 80%, the cost at the time of purchase, the $312,960. That's how much was paid for it. Their interest, their 80% interest in 2000 X0. Basically, what did we say, 4 years ago from the point in time that our current consolidation will be taking place. We had a non-controlling interest at that point in time of purchase of the $78,240. Then the net assets of S at the time of purchase, once again, 2000 X0 is $341,200. We're going to consolidate as of December 31st, 2000 X3. So 2000 X3, that's when we're currently doing our consolidation of P and S's, financials. Then the book value and fair value are the same except for equipment. So there was equipment and it has a difference, and we're going to kind of back into the difference in the equipment. So we'll figure that out, what exactly that is. 10-year useful life, so we will have to be dealing with depreciation for the 4 years since 2000 X0 for the added value of the equipment. Then we have the accumulated depreciation at the point in time of purchase of that equipment was the $39,000. 2000 X2 S. So here's like the intercompany, kind of like the new stuff that we're going to have to deal with here. So it says 2000 X2 S, the subsidiary sold inventory to P. So this is in the prior year. Last year, 2000 X2, we're consolidating as of 2000 X3. There were these sales that took place. So then we're gonna have to think about, okay, what's going to be the effect of that, the prior year sales that took place, and then resold in 2000 X2 last year 60%. So that means that the difference, the 40%, is still on the books in 2000 X3, which we're going to have to deal with this year. So then we have in 2000 X2, P sold inventory to S. So now we're going the other way, P selling to S for the price of the 36 and 27,000 cost of goods sold. S resold in 2000 X2. Again, we're talking last year, 66.667 or 2/3 of it. And then now we're talking the current year, intercompany kind of sales that took place. 2000 X3, the year that we will be consolidating. Then we have the sales for S sold inventory to P. Sales price 42,000, cost 27,300. And then P resold in the current year. They resold them. 1/3 of them, or 33.33 of them. And then P sold to S in 2000 X3. So now we're saying P sold to S the inventory of 22,000 and 16.5 cost of goods sold. None was resold, so they're all still on, still being held. So then S also owes P $10,000. So that's going to be an intercompany receivable and payable we'll have to deal with. We're going to be using this time a modified equity method. So we're using a modified equity method. So let's go over here. We're going to say this is going to be the equity method. Let's make it modified. All right. So then we're going to then move over to our worksheet over here. So we're going to start entering our information. Now, I would think about this in terms of a standardized type of process. So we're going to think about this in terms of our transactions. Here we'll be dealing with downstream, upstream transactions, current year and prior year. Then we'll put it into that information into our little worksheet here. We'll think about the equity method that will be used. And then we'll go to our consolidation entries. So first of all, let's hide some of this information so we can think about just one thing at a time. So I'm going to go from H, and I'm going to highlight all the way over to T. H to T, I'm going to hide those cells. H to T, right-click on the selected area and hide them. So then we have our information to the right, which is going to be P and S's financial statements. Same process there. This is for as of 2000X3, the year we will be consolidating. Let's go ahead and sum these up for now. I'm going to say, all right, let's sum these up. So we need to do that. I'm going to copy this and paste it down. There's like our starting point. So here's basically our starting point. Now we're going to have to do the consolidation entries. To do that, we want to put together basically our worksheets to the left, which will help us out in preparing those consolidation entries. So we're first going to be considering our transactions for the downstream transactions. We're going to be looking at 2000X2 prior year, and then the current year for downstream, and then upstream prior year, current year, downstream meaning going from parent to subsidiary, the downstream. Let's first think about downstream prior year. Downstream prior year, I'm going to say according to our data, we had the amount of the 36 right here. That's 2000X2, P sold inventory to S. So P to S. So I'm going to say, all right, that's going to be that. I'm going to highlight this saying, okay, we've picked up this data somewhere. And then the related cost of goods sold is going to be the 27,000. So that means that the gross profit that was recorded in this intercompany transaction was 9,000. Gross profit percent, 9,000 divided by the sales price, or 25%. That means the cost of goods sold as a percent of or over sales would be, let's make this a percentage, the 75. Now we're going to be considering the amount that was resold. So of that intercompany transaction, how much of it was resold? So I'm going to say it's this 66% was resold. So I'm going to take, all right, let's take this 36 times that 66% was resold. So that's going to be the 24. Now notice the data, the book might give you, the percentage that was resold. They might give you the ending inventory. So whichever they don't give you, you can back into using these two sets of data. They'll be related. Now I can use the gross profit percent or the cost of goods sold percent to figure this number out. The cost of goods sold would then be that 24,000 times either 1 minus the 25 or 75%. So I'm going to subtract those two out. So this minus this. And we could check the percentage just to see if we have the same relationship. I'm going to say, all right, does that bring me to that 25? Yep. Then the difference then in ending, so the ending inventory is representing then this 36,000 minus the amount that was resold. So of the sales items then, we have 12,000 that's still basically representing itself that hasn't been resold yet. And then we've got the 27 minus the 18. And again, you could have kind of figured, well, let's just keep it here. And then I'm going to subtract these two out, the 12 minus the 9. And then again, you could check the percentage to see if we're getting back to that 25% here. So that looks good. Now, let's do the same thing for the downstream transactions for the current year, 2000X3. So same process. I'm going to say, okay, according to the data, we had P sold to S, P to S, downstream transaction, 22,000 cost of goods sold related to it. It's going to be that 16,500. I'm going to make this green, showing that we're did something with it. So we've kind of used it somewhere just for our indication purposes. Subtracting those two out, we're going to get the 5,500. I'm going to make this green too, because we did something with that. And then we're going to say, all right, then the amount that we resold, none was resold. So it's all still on the books. That means that the ending inventory is representing sales of that full 22,000 that was basically intercompany. And then the cost of goods sold, same. And then you could do the same subtraction here, or subtract these out. Same item there. So I'm going to say, all right, let's do that. And now let's look at the upstream stuff. So upstream going from S to P. Now we're going sales happening from S to P now, subsidiary to parent. According to our data, we had this 60,000 sale, 2,000 last year. For S sold to P, 60,000, and the cost of goods sold was 39. So there was a gross profit intercompany sale on the upstream in the prior year of that amount, 21,000. Gross profit percent then, the 35%, cost of goods sold as a percentage of sales then being, going to make that a percentage, 65%. All right, well, how much of those are still have been resold? Well, of that 60,000 on the sales side, we're saying that they sell 60% was resold. 60% resold. If I multiply this times the cost of goods sold percent, 65%, subtracting that out, then we have the gross profit basically here of the resold amount. I'm going to say, all right, let's see if we have the same percentage just to check that out. Should be at the 35% there, you would think. So I'm going to say, all right, that looks good. Now let's subtract this out, and what's going to be left in ending inventory of the amount that was originally the intercompany sale, resold 36,000. Cost of goods sold, we're going to say that's going to be the 39, and then we resold the 23.4 of it, subtracting those two out. There we get that. If we take a look at that gross margin percentage, just to check that one out, we should get the same percentage, which is going to be not the same percentage. What happened here? This equals the 8.4 divided by the 24. There it is, 35%. So there we have that. Let's go ahead and greenify this one up here. This one will be greenified because we've done that one. Kind of found a place for that. Now let's go to the upstream, meaning going from S to P for the current year, 2000X3 in this problem. We say that our data says then that we have 2000X3 S sold inventory to P for 42,000, cost of goods sold, the 27.3, that gives us a gross profit if we subtract those two out of the 14.7. Gross profit percent being then 35%. Cost of goods sold as a percentage of sales should then be, if we make it a good old percentage up here, the 65%. The amount that is resold, how much of that was resold? They're giving it to us in percentages now. We're going to say of the 42,000, they resold 33.333, or basically, 1/3. And so we're going to say, okay, and then the cost of goods sold percent is going to be that times that 65, or 1 minus 35, if you want to think about it that way. Subtracting this out, that gives us our gross profit for the resale of the 449, which means that this should be the ending inventory area here. So it's going to be the 42 minus the 14. The cost of goods sold is the 27.3 minus the 9.1. And if we subtract those two out, then we get the 9.8. It should be the same gross profit percent. So let's just double check on that. Double check. And there we have that. So this looks long and confusing, but notice we just did the same process here for prior year downstream, current year downstream, and then the upstream prior year and current year. So we'll just do that systematically and just use that data into our next worksheet. So now we found a home for this. Let's greenify this. Let's go ahead and greenify it because we've done that. And then we're going to unhide some cells over here. So I'm going to put my cursor on F over to U. Let's bring it over to V. It sounds better. F to V. And then I'm going to right click on that and I'm going to unhide that. And then I'm going to go over and we're going to hide some of this information. We're going to be working on this table now. So I'm going to go from M to T. So M to T, let go, right click and hide those cells now. Okay, and then we'll be working on this worksheet. Now, again, this is kind of a standardized worksheet. You want to kind of think of in a standard way, and then when you have time to mull it over and see why it's all put together, it's worth spending some time with that. All right, so we're really kind of reconstructing. You're kind of thinking about our first journal entry we need typically in the consolidation process. So, and that deals with basically the items posted to the investment and the non-controlling interest and the income from S and so on and so forth. So we're going to think about it from a balance sheet side, allocating out, in essence, S's income, and then the net asset side of things, assets minus liabilities. Top half being the balance sheet, assets minus liabilities here. So top half, we're thinking about the 60,000. So we're going to start with the net income, revenue minus expenses of S that are currently on the books. And then we're going to say, so that's going to be our starting point. So I'm going to say, all right, that's going to be the negative of this total. We'll break that out between the starting point, if that were the number before our adjustments for the non-controlling interest and the parent company interest, which would be the $60,000 for the parent company times the 80%, which means 20% is here, or 60,000 times, we'll put brackets, 1 minus the 80%, which is 20%. Anyway, or you could subtract the two. These two should add up, of course, to the 60,000. Then we'll make our adjustments to that. Our first adjustment, reverse gross profit deferred down. I'm going to be picking this up. This is going to be equal to our information. We're at the prior year. We're looking at this difference information, and that's going to be the 3,000. Now, this is going to be going directly just to P. We're not breaking that out between P and S. Next, we're going to go to the up transaction. These are basically these first two are kind of like the prior year transactions. So now we're going to take a look at the up prior year transaction, which we're going to say, all right, that one is going to be, I'm going to say negative of, I'm going to go down to the prior year. Here I am in 2000x2, and we want this item of the 8,400. So 8,400. This one we will be breaking out between P and the non-controlling interest. So non-controlling interest and the controlling interest, which is going to be, and this shouldn't be a negative number. I don't know why I put a negative, not a negative, unnegative. And then we're going to say this times 80% for the controlling interest. And then I'm just going to subtract them out, or 20% for the non-controlling interest. So there's going to be the non-controlling interest. Then we're going to go to the gross profit deferral down. And so I'm going to say this is going to be equal. And we're basically in gross profit deferral down is going to be this item that we're in 2000x3 now. That's going to be the 5,500. And so for the down transactions, we're just going to allocate that specifically just to P. And then we got the gross profit deferral up, which I'm going to say, all right, gross profit deferral up for basically the current year now, all the way down to the bottom here at that 9,008. And I'm going to say, okay, there is, now we're going to allocate this out. Now, I'd like to represent these as negative numbers. So these are, I'm just going to represent this as a negative so that we could just sum it up a little bit easier in our calculation down below. So these are going to be subtracted. And then I am going to break this out between the interest. This is going to be equal this times the 80%. And then this is going to be equal to this times, or let's just subtract it out, this minus this. So that this plus this should equal the 9,800. So notice the down transactions we're applying to P. The up transactions we're breaking out between the non-controlling interest and P and the controlling interest. Let's go ahead and sum them up now. We're going to say equals the sum, summing this up. And there we have our adjustments. I'm going to copy and paste that formula across like so. So we just sum that across, and there we have it. So now this is going to help us with that first consolidation entry. So that's basically the income side of things. Now we'll take a look at the other side, which is basically the balance sheet side of things. So we're going to start with the book value now, which is either assets minus liabilities, which is going to be that 391.2, or of course all of the equity section here, which is going to be that 391.2. So that's going to be our starting point in our worksheet. I'm going to say this equals the sum of the assets minus the liabilities. So there we have that. Let's break that on out with our percentages. That's going to be this times the 80%. And then the non-controlling interest, of course, being the 20%. So there we have that. And now the meat of this, the middle of this, is just going to be the same as up top. So I'm going to do that with formulas just so we can tie everything together. So it's going to be that, and then this is going to be that, and then this is going to be that. And then you could just copy and paste this down, yeah, but I just want to make sure we have the formulae. So the meat, the middle, all the same. Then I'm just going to sum this across. Sum it across. Copy, paste, same thing down here. Let's put a little underline down there. So all I did was take this, the meat, and just basically put that right on back in to the bottom section. So now we can sum this up. Let's go ahead and sum this up. Sum it. And then copy and paste that. So that looks good. So that's going to be part of our initial entry as well. Let's do our calculation. We had this goodwill calculation. This time they said there was no goodwill. but we have to back into kind of what the fair value of the asset change was. So they give us we got a little bit of a twist here. So we're going to say, all right, how are we going to do this? Well, this is at the point of purchase, our goodwill calculation. We'll just have to do a little tweak to this. I'm going to say, all right, well, this started out at the net assets of S were the 341,000. And then we don't know this number, right? They didn't give us this number. So I'm going to go, they didn't give us that number. But if we had that number, then we would just be summing this up. And that would give us the fair value. And then we'd have the non-controlling interest, which I know that number. The non-controlling interest is the 78,240. And then we would be subtracting those two to get to that. And I know the amount that was paid. The amount was paid was this 312,960, and it should be this minus this, and I know that amount shouldn't be 50 but 0. This amount should be 0. So then what do I gotta put up here in order in essence to make that amount 0? So you could do the algebra here. There's a nice little tool in Excel that I just like to point out whenever I get the chance with something like this, because it's not something I think most people are aware of. It's this goal seek thing where you can I don't have my cursor on the thing on the cell I want. I want to fix that yellow cell or make that something. So I'm going to say set this cell. I'm going to say set this cell, the ending cell, to be 0. And I want you to do that by changing this cell, and they're connected. So I'm telling Excel, please set this cell to be 0 by changing that cell. So I'm going to say, okay. And then it just kind of figures it out to be the 50,000. So there we have it. So obviously you could, okay. You got to make sure you save it before you exit. But the nice tool within Excel. Okay. It works with more complex kind of, anyways. So then we have that. So I've basically used this stuff. So let's go ahead and greenify it. Let's greenify it like so. And then I'm going to unhide some cells to the right. So I'm going to go from K to U, and then select the K to U, and then right click and unhide those cells. Now we're using basically the modified equity. So we're not doing a fully adjusted equity method. In other words, we're just going to record some of the normal kind of equity transactions, not taking into account some of these adjustments that are made here. And then we'll do our consolidation. So let's go ahead and hide these cells. I'm going to hide these and just think about kind of our normal adjusted or modified equity method. So I'm more of a simplified kind of equity method where I'm not. So let's see then. We're going to say, in other words, it's not the fully adjusted equity method. So what would normally be happening under the equity method? Normally, you would say, all right, well, we had the investment in S, and I'm just reconstructing. We're reconstructing, remember, this account, at least for the current year, and this account down here. We're going to be reconstructing, say, how did they get to that number? We're going to say, all right, well, let's just check it out, because that can help us out with the consolidation. I'm going to say, well, normally, we have the investment, and then the income from S, and that's going to go up by P's portion of the net income of S, which in this case is that 60,000 times the 80%. 80%. Normal equity method stuff. And so there's the debit and the credit, and then there's usually dividends, which typically will be cash to P, so P would have recorded cash, you would have thought. And then the other side would be decreasing the investment in S for their portion of the dividends. S gave out dividends of 45,000 times, P's portion. And P owns 80%, so you would have thought that they got $36,000 in dividends. So there's the debit and the credit there. And then we're going to be accounting for the change in the depreciable asset that's going to be taking place in the current year, and that's basically where we'll stop. So we're going to say this is normal equity method, and then we had that depreciable asset that took place. So we're going to say, all right, and then I know that like we had a depreciable asset, which is going to be the income is going to be affected because the depreciation is going to be affected. That's what we're accounting for here. So the income now needs to be going down with a debit. And then the other side is going to go to the investment, the calculation being basically the depreciation calculation for the current year of the added depreciation, which we calculated here to be 50,000. That's that number we had to figure out. So we're going to say, okay, there was a 50,000 increase in depreciable assets. We're going to depreciate them divided by 12, or not 12, divided by 10 is the useful life. And then our percentage of that change would have been 80%. So again, depreciation would have been the 50,000 divided by 10 depreciation, and then 80%, the effect on our portion of it, would be decreasing the amount of the income that's related to them of 4,000 and 4,000. All right, so let's check that out and then say, all right, well, if I add those up, like if I was to say income from S would be, that's going to be income with this and then this. And does that tie out here? So that ties out here, so that looks good. And then the investment, it won't tie out exactly, but I can say, all right, the investment, what happened according to this, investment in S would be this, this, and this. Now that doesn't tie out to here because this is a balance sheet account, and again, they've been going for a couple of years, but given this ties out, we can figure that we're recording it correctly. So if we run into problems, we can fall back on this and try to say, okay, what's going on here? Then let's go ahead and unhide. Again, I'm going to go from O to U, OU, and right click and unhide. So we'll unhide those, and then we'll start to record our elimination journal entries. So remember the elimination journal entries, we're going to be eliminating, at the end of the day, this needs to be 0, this needs to be 0. These equity accounts for the S are going to be basically removed, right? And then we got to record the non-controlling interest on the income statement and the balance sheet. Now we've kind of done so with our worksheet over here, but I want to just do it a little bit just to tie it out to what we've normally been doing, and then we'll just make an adjustment to our worksheet just to switch things up a bit. So normally what we've been doing, we're going to say, all right, you know, the investment is this, and then I'm going to remove basically all the equity method portion. So that's going to be the common stock, that's going to be the additional paid-in capital, the retained earnings, and the dividends. And I'm basically going to record those first for S's portion. So I'm going to remove S's portion. So there's a credit here. We're going to debit on this side. So we'll debit then the 120. Then we're going to debit the 18. Then we're going to debit the retained earnings for the 238.2. Then we're going to credit the dividends for the 45,000. Let's go ahead and record those as we go, because this is something that, you know, this will be the same here, so we can at least feel confident here. So I'm going to say there's the 120. That'll take the 220 minus and the 120 added up minus the 120 brings us back to P's portion. We'll do that again here. I'm going to say, all right, there's the 18. We're going to say there's the 238.2. Again, this is basically reflecting now P's side of things after we're done here. And then the dividends. So then we have the dividends. Okay, and then the other accounts that are typically going to be affected here is we're going to say, this is what we normally do. I'm going to do this just the way we normally do it. I'm going to say there's the income from S. And normally what we've been doing is saying, hey, let's record that for P's portion of the net income of S, right? P's portion of the net income of S, which would be, I'm going to say this is going to be a debit of the 60 times the 80%. Now we're going to adjust this according to our table over here, but it might be easy to kind of see what we've done and then do the adjustment just to see how this works. And so, okay, so we got that, and then we've been saying, all right, then there's then there's the non-controlling interest. So non-controlling interest here, and we've typically been saying that the non-controlling interest would then be a debit of the 60,000 times 1 minus the 80%, which of course would be 20%, and that would be the 12,000. Then we've got the non-controlling interest on the balance sheet side of things, basically net assets. So that's going to be the assets minus the liabilities, or the equity section, both adding up to the 391.2 times the non-controlling interest, which was 20% here, right? So, or in other words, this is what we have now, representing the 391.2, which is assets minus liabilities, 391.2, which we will be breaking out between the non-controlling interest and the controlling interest reflected in the investment in S. Okay, so I'm going to say, all right, this is going to be the sum equals the sum. Let's take this minus this, assets minus liabilities, times, and then 1 minus, and then we'll pick up then the 80%. And so there is that. And then the other side going to the investment in S, which I'm going to do the same thing. And this should be a negative. I'm going to do the same thing up here. I'm going to say, all right, this should be the negative sum of assets minus liabilities times 1 minus. Let's put a bracket. The bracket went the wrong way. That's not how you do a bracket. That's not how brackets are done. 1 minus the 80%. And so there we have that. And that should be in balance. And that's kind of our normal way that we've thought about this. And it's not in balance. What happened? What happened? This one should just be not 1 minus 80%. This should just be the 80%. This is the controlling interest. So that times 80%. All right. Now let's see if we're in balance. Okay, so that's in balance. So that hopefully makes sense to us, right? But we're going, and then if we record this, let's record this out so we get everything in place here. I'm going to say, all right, then this is going to be equal to the 312,960. We recorded this. Let's go to the income from S. Income from S is 48. Now that doesn't go to 0. Let's go make this the yellow-red combo I like to make. To emphasize it, kind of stands out, the yellow-red combo. So we'll make that a yellow-red combo up here too, because those are the ones we're focusing on. So we're going to say this one's going to be a yellow-red combo. Okay, so then that doesn't take it down to 0 yet, right? So we expect that to be 0 at some point. And then we've got the non-controlling interest down here. So non-controlling interest of the 12, and the non-controlling interest here being the 78,240. 78,240. That puts us back in balance. Now what I'm going to do is I'm going to make an adjustment to basically tie this out to the table over here, just so we could see kind of our normal transaction. Now we're going to say, all right, well let's adjust this just according to basically our table. And to do that, we're gonna do an adjustment to the non-controlling interest here, and the non-controlling interest there, and that should do it. So I'm going to take, okay, I'm going to say, then this was 12, and I'm going to, if I was to make it the difference between what's on the non-controlling interest table, it would be the 11,720. So the 11,720, and then I'm going to say negative of that amount is going to be the 280, which you can also think about it being this number plus this number, the difference between them, the 280. So notice this is a little different because remember, then you may have on the full equity method because we're not making an adjustment to basically P side because the account here isn't reflecting these adjustments within it because we didn't use the full equity method, right? We did these adjustments for the equity method. We didn't do the adjustment, related to all these items. So then we're going to just make this adjustment to the non-controlling interest tying into our table. All right, so adjustment to the non-controlling interest, that's in the balance sheet. So I'm going to say F2 plus F2 is going to be that 280. And then, so now this amount, of course, that 77,960 is going to be that 77,960 here. And then we're going to say, all right, then this one, I'm going to say F2 plus F2, this is going to be that 280. So now that 11,720 is going to be this 11,720 there. Okay, so now we'll do some of our standard kind of entries that we have. One is going to be the depreciation that we're going to have to do, the added depreciation for the assets that we have put in place above the depreciable assets above what they, for the current year. So that's going to be depreciation expense we'll be recording. I'm going to put the depreciation expense a couple ways you can think about it, but the calculation would be, we're going to say that's going to be that added 50,000 divided by 10, because we're going to say it's a 10-year life, straight line depreciation we're going to be doing this from. And then I'm going to be allocating this out, and you could think about this a couple different ways, but I'm going to allocate it out here to between the basically income side accounts, meaning income from S and the non-controlling interest income account. Okay, and that's going to be, I'm going to do this with the percentages, negative of that times the controlling interest percent, which is 80%. And then this one would be 20%, or you can use the negative sum equals the negative sum. Let's do it this way this time, which would just be 20% of that, of the 5,000. All right, let's record that out. So I'm going to say, all right, there's depreciation is going to be here. And then the income from S, I'm going to say F2 plus F2. And then the non-controlling interest, F2 plus F2, that 1,000. Okay, next one we've seen before as well. We're gonna increase basically the assets that need to be put on the books. One being goodwill, one being the machinery and equipment at the point in time that we made the purchase. When the purchase happened. So the machinery, the depreciable assets, the machinery needs to go up by that 50,000. Which is here, we calculated it to be. So, and we also know that the goodwill needs to go on the books. So goodwill needs to be going on the books. Actually, there is no goodwill, so no goodwill in this problem. So I'm gonna also add the accumulated depreciation that has accumulated since that point in time, since the purchase. So that's gonna be accumulated depreciation, which is going to be, I'm gonna say negative of that 50,000 divided by 10, which would be the years that we had. And then I'm going to multiply that times 2 that we have. No, it's times 4. It's been 4 years times 4. There we have it. And I went all the way back to the right here just to that's because this took place in X0. So it's been X0, 2, 1, 2, and 3. Meaning there's 4 years now that have passed. So the accumulated depreciation, including the current year, is going to be adjusted for that 4-year time period of the 20,000. So this is the effect, basically balance sheet side effect of things, right? We recorded the income statement side here, balance sheet side here, which we're going to allocate to the two kind of balance sheet accounts between majority and minority interest, and that's going to be the investment and the non-controlling interest on the balance sheet for the NA, the net assets. So then we're going to say, all right, I'm going to take the sum of these, which is going to be the 15 allocated 80-20. So 80-20 allocation, negative sum of these, and I'm going to say times, and then let's bring it on over to that 80%. There we have that. And then this is going to be the 20%, which I can just say negative sum, the plug formula here. But that should tie out to 20% as well, that you might want to double check by doing the 20% calculation, and that should put us in balance. So let's do that. Okay, are we in balance? Let's check. Yeah. Okay. Machinery. So we'll post this up top. I'm going to say, all right, here's the machinery. And then we got the accumulated depreciation. Accumulated depreciation. And then we got the investment in S. So that's not it. Investment up here. F2 plus F2. And that's going to bring that down to 0. That's good news. That's what we like to see. And then the non-controlling interest, F2 plus F2, is going to be that 6,000. Next thing I'm going to record is there's an intercompany transaction. We said that there was amount that was, I think, SO to P that was 10,000. So in other words, if we looked at the accounts receivable, I believe for P, we'd say, hey, SO's P, 10,000. So we'll eliminate that. And then the other side would be on P's accounts payable. So we've seen this in the past. We'd say, okay, we got to eliminate that. So we're going to say accounts payable needs to go down. And the accounts receivable is going to go down. So let's go ahead and record that equals, and we're going to say that's going to be for, where did they say that? There was intercompany stuff was happening. There it is. SO's P, 10,000. So we will remove that. Seen that in the past. So we're going to say, all right, we'll remove that. And so we're going to go on up to the accounts payable. We're going to say there's the accounts payable decreasing. And then the retained, or the accounts receivable also decreasing. So we will remove those. They also said the accumulated depreciation at the point of purchase was 39,000. We're going to net that out into the machinery as we've seen in the past. So as of the point of purchase, there was accumulated depreciation of 39. We're just going to group that together in the machinery as if like kind of a purchase took place as we've seen in the past. So that's one of our standard transactions where we debit accumulated depreciation. The credit then going to the machinery. They're going to give us that in the data. So if I scroll back on over, that was this 39,000. 39,000. So, okay. So we've seen that before. So then I'm going to go up, all right, accumulated depreciation is here. I'm going to say F2 plus F2. And we're going to debit that one. And then the machinery on top, F2 plus F2. And we'll then say that's going to go down. Now we're basically going to remove the cost of goods sold for transactions that happen in the current year. In other words, let's take a look at it. I'm going to say cost of goods sold. These items represent transactions that basically happened in the prior year. So we're going to reverse those to the cost of goods sold. So we're focusing in on this section right now. I'm going to say, all right, that's where we're focusing. I'm going to say that I'm going to say cost of goods sold. We will be recording a credit. So I'm putting it on top, even though we're going to credit it for the total of these two. Now, I'm not going to break it out on the 80/20. We're going to break it out in accordance to P and the non-controlling, P and the non-controlling interest here. So the non-controlling interest, I'm going to say this is going to be, actually, let's put it in, one is going to be the retained earnings. So it's going to be the retained earnings is going to be adjusted. And the other side, and it's the retained earnings because, again, we're using, and this is a little different because we're using the modified accrual method here. And the other side, and so, we're adjusting the cost of goods sold timing kind of difference between the cost of goods sold and an income statement account and retained earnings, basically the balance sheet account. And then the other side's going to the non-controlling interest, not on the income statement, but the basically balance sheet non-controlling interest here. So then I'm again not breaking it out 80/20. We're going to say the amount that's going to go to the retained earnings will be the sum of these two that are in the P column. And the amount that's going to be going to the non-controlling interest is that 1680 according to our table. All right, and then we'll record that one out. We're going to say, all right, cost of goods sold then is going to be equal to the 11.4 retained earnings up top. So we got retained earnings. I'm going to say F2 plus F2 down to the retained earnings of the 9720, and then the non-controlling interest in the NA here, F2 plus F2, and we're going to be picking up that 1680. Then we're also going to be removing the sales. So I'm going to say sales, I'm going to be debiting. We're going to be debiting it for, I'm going to say equals the intercompany sales items being overstated. That being, if we go, this is last year, so not that one. This is the current year, 22,000. And then plus, we've got the current year upstream, the 42,000. So these are the sales that are intercompany that we're going to reduce, that being the 64. Then I would typically go to the cost of goods sold, and we're going to hit the related cost of goods sold, negative of, and I'm going to be taking, again, the current year cost of goods sold, the 16 plus, in the current year down below, we have the 27.3. So there we have that. I'm sorry, I shouldn't have said plus, I should say minus here. I should add those together and make it a negative. So those two and then make it a negative, or -1 minus the other. So that would give us the 43.8. And then I'm going to say then the inventory is going to be the other side of this thing. So I'm going to say inventory is here, and that's going to be the negative sum. So it's like negative sum. And there we have that. And then I'm going to do one last adjustment, which is going to be for, we're going to say the cost of goods sold. I'll put it on the bottom this time, is going to be credited. And then we will debit the inventory for, I'm going to be picking up then this amount here. I'll try to, explain this a little bit more in a second. This is going to be the resold amount for the Upstream transaction 2000x3. And so then I'm going to say this and this. Okay, so that's going to be one. So this is one way you could think of it. This basically two journal entry kind of transaction like this. And the reason I like, these two kind of make sense, because you could say, okay, those kind of go together, and then I need to make an adjustment for this 4009. You can also basically do this journal entry if you were to say, all right, what if I did, you could say, let's paste it. 1, 2, 3. You could say, if I had the same 64, you could then say, well, let's think about the inventory first. And you could pick up the inventory from the second adjustment up here from our table. So you could say it's actually going to be this on the table here, these two, the sum of those. And then that might, be easy, ring better for you for some people. So then you can say, well, if, that's going to be the difference in the table there. Did I pick that up right? Let's do that one more time. This is going to be the negative sum. Say negative sum of these two. And then brackets. There it is, 15.3. Actually want it to be a negative number, so then it would be this, and then this would be then the plug. All right, this plus this. So that's an alternative that you can do. This should be on the other side. This should be here, and then I'll say, so in other words, you get to basically the same result, right? This, and I'm holding down control, and that is the 48.7, and then this and that is the 15.3. So I'll put this down here as an alternative, and I'll make it yellow so it'll be on your worksheet, but we won't post that one. So now let's go ahead and post this. We're going to say, all right, let's post this up here. We're going to say the sales then is going to be that 64,000. The cost of goods sold, I'm going to say F2 plus F2. The 43.8. The inventory up top. So we'll go on up to the inventory. So there's here. I'm going to say that's going to be the 20,002. All right, back in balance. Then we're going to record this inventory here. So I'm going to say, all right, inventory. I'm going to say F2 plus F2. That's going to be the 4009. And then the cost of goods sold down here, I'm going to say F2 plus F2. And that's going to be the 4009. So there we have that. So there it is, and this is our worksheet.